Before we begin, please support the channel by subscribing, liking, and sharing this video. Constructive discussion is always welcome, and we invite you to share your views and insights in the comments. July 2026 Market Update. This video presents a direct informational narration of the source document. Okay, let's dive right into the structural market dynamics that played out on July 2nd. At first glance, it looked like a relatively calm day for the broader indices, but beneath the surface, we saw a highly localized rotation. Specifically, a very real cooling off in the AI and semiconductor supply chains that ended up impacting the broader market.
Here's our roadmap for this explainer. First up, the broad market and memory sector. 2. Apple and memory supply chains. 3. Cloud computing margin concerns. 4. Labor data and market sentiment. 5. AI hardware financing parallels. And finally, number 6. Tesla and sector hardware updates.
Starting with Section 1, Broad Market and Memory Sector.
So the big headline number capturing the shift in the tech hardware space is a 5.44% drop in the semiconductor index. That pullback brought it right down to test its 50-day moving average. And the contrast here is absolutely wild. This massive semiconductor sell-off happened while the S&P 500 essentially closed flat. The Nasdaq only dropped 0.8%, and the Dow Jones actually rose by 1.14%. So capital wasn't fleeing the market. Instead, it was just rapidly rotating right out of the AI and semiconductor narratives.
Now, this rotation triggered a major cascading effect globally, especially in the memory sector. Over in South Korea, the Kospi index actually experienced a plunge severe enough to trigger a circuit breaker. And this was heavily driven by steep losses in memory giants like Samsung and SK Hynix. That weakness transferred directly over to the US DRAM sector, which saw a broad and immediate decline across the board. Take Micron Technology, for example. It dropped 5.5%, rapidly backing away from those previous $2,000 targets just to aggressively defend the $1,000 psychological support level.
Moving on to Section 2, Apple and memory supply chains.
The catalyst behind a lot of this is directly tied to Apple's forward-looking production plans. On one side, we have Apple revising its production targets upward for its first-ever foldable iPhone. They jumped from an initial target of 7 to 8 million units all the way up to 10 million units, which signals some incredibly strong sales expectations. But at the exact same time, reports emerge that Apple is actively negotiating with Chinese memory chip manufacturers, specifically YMTC and CXMT, to source memory chips for certain products bound for the Chinese market.
So what does this mean? Well, this specific supply chain diversification rumor directly sparked structural fear in the market regarding margin compression for Micron. Wall Street is suddenly very concerned that Apple is going to systematically use this supply chain diversification to phase out Micron's consumer-grade memory market share. And if that happens, it severely reduces Micron's pricing power. It was this specific threat that basically hit the brakes on the memory sector's momentum.
All right, Section 3, Cloud computing margin concerns.
The source documents also outline some pretty massive strategic shifts among major players when it comes to AI computing power. For instance, Meta noted internally that its AI software development speed isn't exactly meeting expectations. Plus, pivoting toward cloud computing carries a much lower profit margin profile compared to their core advertising business. Meanwhile, SoftBank announced plans to launch AI services in the US, signaling that they're going to ramp up the leasing of their compute power by next year. Basically, the major players are shifting toward a model where they just rent out their excess compute capacity.
And this brings us to a core institutional fear, the actual commoditization of compute. Think about it. When tech giants take their contracted compute power and throw it onto the open market as a wholesale commodity, it triggers major fears about long-term cloud service margin compression. The market is aggressively repricing these emerging cloud providers right now because if compute just becomes another wholesale product, those high future profit margins everyone anticipated could literally evaporate. Let's look at Section 4, Labor Data and Market Sentiment. The June U.S. jobs report actually delivered a stark surprise. Only 57,000 new jobs were added in June. That is exactly half of the 113,000 jobs economists were expecting. To add to that cooling picture, the previous month's data saw a sharp downward revision, dropping from 172,000 down to 129,000. Meanwhile, the overall unemployment rate just ticked down slightly, going to 4.2% from 4.3%. Now, initially, this cooling labor data gave a nice boost to broad market sentiment because it raised expectations for Federal Reserve rate cuts. But those severe tech stock declines we just talked about ended up dragging the market's early rally right back down to earth. Section 5. AI hardware financing parallels. This is absolutely crucial to understand.
The source materials highlight a reported proposal for the U.S. government to actually take a 5% stake in OpenAI. Officially, this is being framed around regulatory compliance and public interest, but the market is reading between the lines here. The core institutional concern is this. If OpenAI had enough cash on hand to fully support its massive future compute expansion, it really wouldn't need to hand over a 5% stake to the government just to secure survival and resources. To investors, this signals that the speed at which AI models are commercializing and making money is significantly lagging behind the crazy high burn rates of their hardware expenditures.
Compounding all this tension, the major players are actively trying to cut down their reliance on top-tier suppliers. OpenAI is already in negotiations for custom AI chips, setting up partnerships with Samsung Electronics and Broadcom. This is a highly strategic attempt by massive clients to completely bypass NVIDIA's hardware ecosystem. They're desperately looking for ways to lower costs and avoid the bottleneck of relying on a single dominant supplier.
And this creates a really powerful historical juxtaposition. According to reports, NVIDIA's current strategy involves giving financial backing directly to small cloud providers, taking a cut of revenue sharing, and even promising to lease or buy back hardware if those providers fail to find AI developers to use it. Now compare that right alongside Cisco's strategy back in the year 2000, where they extended massive vendor financing to telecom operators just so they would buy Cisco routers. The parallel here perfectly illustrates the intense concentration of downstream risk. Sure, locking in short-term orders through financial engineering makes the financials look spectacular today, but the foundational risk is heavily tied to the balance sheet, and the market is finally waking up to that vulnerability.
Finally, Section 6, Tesla and sector hardware updates.
Tesla presented a truly fascinating paradox in this session. Their actual Q2 deliveries came in at an impressive 480,000 vehicles, which easily crushed the expected 396,600. Yet despite that massive beat, the stock reaction was a severe 7.5% drop. So what happened? Well, the source points to a drastically lowered market tolerance for any kind of AI delays. Investors are increasingly viewing Tesla as a pure AI and robotics company, not just an automaker. So the moment Elon Musk clarified that initial production for the Optimus V3 robot was going to be slow because the tech is entirely new, investors instantly had a reason to take profits, completely ignoring those excellent delivery numbers.
Concluding our hardware sector scan, we have a few isolated but important updates. The capital that rotated out of AI hardware actually provided a nice bounce for crypto assets during this session. Furthermore, Amazon is planning to roll out its own custom consumer chips by 2027 in an effort to lower its AI infrastructure costs. This broader shift toward internal in-house development creates some serious rising long-term margin pressure on external suppliers, companies like Qualcomm and MediaTek, who are now staring down the very real risk of losing massive client orders. So when we connect all these data points together, from the threat of memory margin compression to these striking vendor financing parallels, the crucial question we are left with is this. As hardware commoditization and historic financing parallels emerge, how long can the AI hardware rally sustain its current valuation metrics? That is the central, provocative tension the institutions are wrestling with today. Thank you for joining this explainer, and we'd love to hear your insights on this critical question in the comments below.